with risk on, risk off. So we did touch up on this topic slightly in the previous session in risk sentiment. So we're just going to go into a little bit more depth now in terms of which currencies are risk on, which ones are risk off, for example, and we'll just show some examples as well. So let's run straight through it. So as we learned in the previous lesson, understanding where money will flow is very important. We know there is either two environments, risk on or risk off. Either of these can throw fundamental biases out the window. For example, you may understand that you want to be buying the Australian dollar because of clear fundamental strengths, but if there's a major issue in China that causes them to spend less, the Aussie will likely struggle to appreciate. So let's start with risk on. So there are currencies or even asset classes that people look to buy in optimistic times, which will be when we see global growth like GDP beginning to pick up, or a certain risk event is beginning to subside, such as the aftermath of COVID-19. So I'm talking about the aftermath of 2020 COVID-19. Knowing where capital flows to and why gives a trader a massive edge in the market. This is because risky assets or currencies tend to be more volatile and yield the best profits. But if the type of event isn't in your favor, you will tend to see it struggle to appreciate in value. For example, during the height of COVID-19 in 2020, we saw oil markets crumble due to demand faltering. It fell to $0. Of course, that was coupled with other fundamental, oil fundamental issues, but demand was a huge issue, of course, during 2020 COVID-19. You weren't allowed to go out, you weren't really allowed to drive anywhere, people weren't flying, etc. So it only made sense for the prices of oil to fall. However, once the economies began to pick back up, demand began to creep back up as well, and this is a good environment to be long oil. But if you knew that as COVID-19 was ripping through economies, you understand that this is a risk-off environment, which isn't good for the risky asset class. Each asset class is unique and carry their own risk tolerance. Investors are forced to invest wisely into specific asset classes depending on the perceived risk in the market. Just imagine if you understood what the risks are, understood where the money is flowing, you're a step ahead of most traders instantaneously, and are now shattering the big flow in the market. This is why you always hear the phrase follow the whales, which you don't follow the whales just by looking at technicals, you look at fundamentals, and that tells you, are we risk on, risk off? Do we want to be buying this currency because of the fundamental data? Do we not? Why do we want to do it, etc. So of course you'll learn that during this video series. So let's start off with the risk on currency. So Canadian dollar. So as Canada exports a majority of oil to the rest of the world, this is closely linked to risk. If there are any issues with global demand, oil will likely fall, and as a proxy, so will CAD. This is due to a lack of demand for their currency. You can monitor the price of oil to understand how the demand and supply is presenting itself. Generally, if the prices are rising, you would expect demand to be high and supply to be low, and vice versa. So below is a chart of CAD, which is this, and a chart of oil. So as we can see here, if you're buying USD CAD, you're saying, dollar is stronger than Canada. And if you're short, you're essentially saying the dollar is weaker than Canada. Of course, naturally. So if you see oil falling here, you would have a relatively idea that, okay, maybe we might start to see CAD start to weaken off because it's the close link between them two. Remember, these type of correlations isn't always one-to-one though. So just because oil is moving higher doesn't necessarily mean we have a stronger CAD. You have to also look at the fundamental bias as well within Canada. So, but as an example here, CAD started to weaken off, but so did oil around the same time. Where these lines are exactly on the same day. So as you can see here and here, exactly on the same day, oil started to crumble, and so we saw a huge rally in USD CAD. Australian dollar, as we know as well, that's quite a risk on currency. So Australian dollar, as Australia is closely linked to Asia, in particular China, any major issues that occurs in the region, Australia tends to struggle. Australia also exports the large majority of their iron ore to China, as they use that to build steel. If they have an issue in their economy, they'll likely buy less ore. So below is a chart of iron ore and Australian dollars. So Here is iron ore. The ticker for this is FEF1 exclamation mark, and that's on TradingView, and of course this is AUD/USD. So as we saw here, when we start to see a big rally in iron ore, again on the same day, as you can see here at the bottom, when we saw a huge demand for iron ore pushing higher, as you can see here where the cursor is, then we saw a big rally in Australian dollars, US dollar. Of course, if you're buying this, you're saying Australia or Australian dollar is better than the US dollar. And of course, again, like we said, it's not always a one-to-one correlation, but there's a fairly quite a closely knit link between iron ore and Australian dollar. So it's definitely something to be very much eyes on for sure, and add it to your trading toolbox. New Zealand dollar. So this primarily exports commodities such as dairy, timber and meat globally. So any issues with global risk, they will struggle as people will spend less. Although New Zealand's main export is dairy products, it hasn't got too much correlation with the commodity prices. Please note, to understand where NZD may price toward, look at the overall risk sentiment. So with the dairy chart, it moves up and down, up and down, up and down, up and down like that, rather than in kind of a straight line. So there wasn't too much correlation there. So if you, like I said, if you want to understand where New Zealand dollar may price towards, or might, is it going to appreciate or depreciate, just look up the overall risk sentiment, i.e., is global growth picking up? Is it not? Is there issues with, is there any sort of wars happening? Is there any sort of, pandemics, for example, any issues in China, etc.? That will give you a fairly good understanding as to, are we risk on or risk off at the moment. So yeah, New Zealand dollar is a risk on currency. So Norwegian krone, some of us don't really trade NOK, but I wanted to put this in as it is part of G10. But Norway primarily exports oil. So as we know, it's closely linked to risk on mood. If the demand for oil is low, you will likely see their currency struggle. In addition, Norway has a good economy and low public debt, which also tends to help them as well. So below is a chart of NOK versus oil. So this is USD NOK, and this is oil as well. So if you're buying USD NOK, like we've mentioned, you're essentially saying that US or the USD is far better, or in a much better situation than the Norwegian krone. So as we saw here, if this pushes higher, you would think, okay, well, how's oil doing? Of course, you would look at the fundamental data as well, but this will give you a fairly good understanding as to why this is happening. As you can see here, even at the back of 2020, we saw oil start to fall, and we started to see USD NOK rising. So NOK was weakening off, and it's like Canada as well. It's closely linked to oil. British pound. So when the global risk is on, you will tend to see investors more likely to invest in the UK, as it's heavily reliant on financial and service sectors. Although the UK doesn't primarily export commodities, we'll compare GBP USD versus the stock market. So of course, stock market is obviously a risk on. People tend to buy that in times of perceived risk, because it just yields better, and also the British pound too. So as we can see here, GBP USD, so risk off is obviously this pushing lower, and so is the stock market. So it's not like a negatively correlated, but if you think that, well, we're starting to turn slightly risk off, for example, then you might have a perceived understanding that maybe the stock market is going to perform badly, and as a result you might have an idea that, okay, well, the pound is clearly a risk on currency, so if we're a risk off environment, pound will likely struggle. And as we can see here, when we saw the rally up here in the stock market, we did see a big rally. If you go back into early 2020 or early to mid 2020, you start to see that the pound rally on the back of that. Of course, there's more fundamental issues with that. We'll go into that with themes, market themes, which is quite important, especially during this type of environment that we're currently in. Themes are always developing, but pound is very closely linked to risk. So of course, remember, always look at the fundamental biases as well, and data. So risk off. So in complete contrast to risk on, we obviously have risk off. During times of unrest, investors and traders will look to buy assets that are deemed less risky. As they are less risky, they will tend to yield the least profit. Investors tend to want their money in something, so these assets are bought. There are events that create unrest, such as most recently COVID-19. It can also be wars, for example, the one happening in Ukraine, and it can also be financial crises like global financial crisis, or GFC for short, which happened in 2008. During COVID-19, we saw risk-off currencies such as the dollar, the Swissy, and the Japanese yen strengthen. These are just some examples of risk-off currencies. We'll get into more later on. In addition to currencies, you can also look at risk-off commodities such as gold and silver. You may have heard of investors buying gold when there's recession fears or major risk-off events. We can all remember 2020. This is arguably a risk-off year where investors attempted to reduce the risk to their portfolio by selling existing risky positions, and that's why you saw the stock market crumble. They were just selling all that risk, right? They wanted to get out as soon as possible, and they shuffled their capital to low/no risk positions. For example, they bought bonds, which is a risk-off asset class. They also bought currencies as well, like the dollar was bought when COVID was first announced. So there's quite a few asset classes, but we're going to go more for the currencies today. So Japanese yen is closely linked to global health. As Japan has a large current account surplus, it typically means that they lend out a lot more money to the rest of the world. As they have a lot of money to lend, this means the JPY is stable. Below is an example of the Japanese yen versus the stock market. Of course, this is risk on, i.e. the stock market is risk on. This is, or the yen is obviously risk off. So when we started to see big bouts of risk on, which is this, we start to see the stock market increase as well. So you can kind of have an idea, well, if they're starting to see the stock market increase, we might have an area or an idea that maybe investors are pulling out of risk-off assets and starting to pile into risk-on. So, of course, Japanese yen will struggle in times of risk-on and obviously appreciate in risk-off events, right? So if you start to see this, for example, which is obviously Canadian dollar versus the yen, as we know from previously, the Canadian dollar is obviously a risk-on currency. So if we saw this move higher, then we think, okay, well, we probably don't want to be buying the yen at this stage because we're slightly turning risk on now. Sorry. Of course, you don't look at a chart to understand if we're risk on, risk off. You'd look at data and events, etc. But then you go onto the charts and then you look for entry points, etc. But yeah, this is just an example of the yen weakening in times of a risk on environment. So Swiss franc. So as their currency is liquid, it makes it easier. Get rid of that. It makes it easier to buy and to sell in large amounts, which contributes to risk-off status. In addition, due to the historical circumstance, Switzerland has a long history of economic and political stability. So it only makes sense that it's deemed as a safe haven currency. And obviously below is a chart of CAD Swissy versus GBP USD. So these aren't, I wouldn't say they're correlated, but I'm just showing examples of risk on versus risk off, or etc. etc. So when this happened, Canadian dollars selling off, so did the GU as well. Of course, the dollar is a risk-off currency as well. So as you can see, when there's a risk-off event, this is during COVID, of course, February 2020. So people sold risk and obviously bought risk off, or less risky, shall we say. So as we saw, people buy and bought the Swiss. So that means, CAD Swiss moves well, right? You're essentially saying Canada is at the moment weaker, or expected to be weaker in the future than the Swiss. And obviously, if we saw all the issues with COVID happening, we think, well, that only makes sense, right? It's a big risk-off event. People tend to be buying the dollars, people tend to be buying the yens, the Swissies, etc. And obviously sell risky assets like Canadian dollar and also the British pound. So as we can see here, just an example of the Swissy strengthening in times of unrest, and also the dollar as well, which we'll get into. So obviously the US dollar, obviously as the US is classed as the world's largest economy, investors park their cash in the US due to safety. Also, the US has a pretty stable political environment in comparison to other economies and has a large history of stable currency in times of unrest. Below is a chart of USD CAD versus GBP USD. So obviously USD CAD is what? A risk on currency. Pound is a risk on currency, and obviously the dollar, as we know, is risk off. So if we start to see USD CAD push higher, or fundamentally we look at all of our data, everything that's happening on in the world at the moment, and say, okay, well, based on everything that we've seen, heard news-wise, any political issues, any sort of wars happening, we are currently in a risk-off environment. As a result, then you think, okay, in the back of my mind, I probably don't really want to be buying risky assets like the pound or the Canadian dollar. Of course, there's going to be times when CAD may strengthen in risk off. That's because of potential fundamental strengths that may be happening. And that obviously takes work and time, but you will learn that as we go along. So as we said, US dollar, obviously risk off currency, strengthens. Pound, obviously risk on currency as well. When there's a risk off event, you'd see it struggle. Obviously everyone bought the dollars at that stage, everyone's buying dollars here, so it only makes sense for this to move higher and this to move lower. So again, I wouldn't say these are correlated, so i.e. you might be like, some people like to look at correlations, be like, I buy USD CAD, I want to short this pair, or if I'm buying this pair, I want to be short that pair. I don't really look at that type of correlation. So it may work for some people. Personally, I just don't like looking at that. Everyone has their own trading style, but I just wanted to show that comparison here. So thank you for joining me today with the risk on, risk off. Next, we'll move on to themes of the market.